TowneBank Mortgage is an equal housing lender. NMLS number 512138. This is not a commitment to lend. Welcome, everyone, to the April edition of Wilmington Mortgage News here with TowneBank Mortgage Wilmington. I am your host, Tyler Cralle, and with me, as always, is the Southeastern North Carolina sales manager for TowneBank Mortgage Wilmington, David Macaione. David,
hey, everyone.
Good to see you.
Hey, good to see you as well.
It's been a while.
What happened to March?
Yeah.
We missed March.
March, there was a lot going on that I think was a little bit above my pay grade with regards to what was happening in the market. So I took a little break. We're back here in April, and we have actually had some developments because, as we all know, we've been talking about this since we started the show, that we're watching really two main reports. That's we're watching the labor market and we're watching what's happening with inflation. And for the first time, we've seen some kind of changes with regard to the labor market, which we're going to get to in a second. But I do want to start with probably the most important being inflation, because obviously that's really what kind of caused a lot of the concern. Because if you have a hot labor market, but inflation's not a problem, the Fed's probably not going to be that upset about that. But it was when inflation took off is when we started seeing these rate hikes, which of course push mortgage rates up. And we recently got the latest report from, of course, of the Consumer Price Index, which it was a big jump. It was a big drop, I should say. Consumer prices fell from February to March from 6% to 5%, and we're now at the lowest level that we've seen since May 2021. It was only a 0.1 increase month over month. That was the lowest level that we've seen since December. So we're seeing some positive movement. I mean, 5% is still well above double the target rate, but the markets, I think, were somewhat happy. However, the reaction wasn't as big as I think some were thinking.
What was the peak in inflation?
9.1.
So, and now we're at 5.1.
5% even.
So it's good to see that the Fed raising interest rates 5% has cut the inflation rate almost in half.
Yes,
so the Fed is actually doing its job. It's the bitter medicine that you need to bring rates down eventually. And so we also have seen the 10-year Treasury peak out at about 4.25%. And now we're at, I think today, 3.4, 3.42, somewhere around there. And, I'm going to say this right now. There's a man that I've been watching. I kind of watch CNBC maniacally. And there's a guy named Rick Santelli. And he gives all I actually met Rick in Chicago. And he gives all the economic data every morning. And he's the interest rate. He's an interest rate trader by heart. And he believes that 4.25 is the peak in the 10-year.
Really?
He said that a couple weeks ago. So, that does not mean that the Fed is done raising interest rates, but you can actually see the Fed raising rates, and you can have the Fed going up while bond yields are going down.
Well, and I think that is important because I think a lot of people who don't follow this every single day don't understand the relationship between, what's happening with the 10-year and what the Fed does and everything. But mortgage rates, they're not 100%. I mean, it's not, they don't move in parity or whatever. But there is a connection between the 10-year and what's happening with mortgage rates. That's more important to follow than say, what's happening with the Fed, hikes, because the markets, for the most part, when a Fed hike is announced, have already priced that in. It's not like the Fed hikes rates and all of a sudden mortgage rates move one way or the other. They sort of know what's going to happen, and so that's already kind of priced into the bond market.
Generally speaking, yes. Yeah. And as long as we continue to get this good inflation deceleration, disinflation, I don't know where we're at. As long as we continue to get that, I think that we've seen the peak in interest rates. Now, it seems to have been going just one direction for a while. Like, we're probably due for a bad inflation report. Although there are people that think as the housing works in, you have to understand how they look at it month over month. So we could see the shelter costs start to really impact the CPI.
Yeah.
In a good way.
Yeah, well, and right now, the report actually said this. A lot of times these reports are very kind of, they don't really they don't get into a lot of explanations. It's just like, here's the data, here's what's going on. But this report specifically noted that shelter costs were the dominant factor in the monthly increase in the core index, because even though the top line number fell to what we're talking about, the overall number, the core CPI actually increased to 5.6% after a 0.4% increase in consumer prices. So we actually saw the core CPI increase while the rest of the sort of top line number was falling. Right. And so I think that's kind of what surprised a lot of people. And the number one reason was shelter costs. The shelter index rose to an all-time high of 8.2% after a 0.6% increase from March. And then the one silver lining that I found in the report, I was trying to find one with regards to shelter costs, was the 0.1% rise in the annual rate was the smallest increase that we've seen since May 2021. So what I took from that was that it's slowing. It's big slowdown with regards to shelter costs. So we may be seeing kind of the peak in the impact that it's having on the overall numbers.
Yes, I agree. Or I'm hopeful.
Yeah, and then
I'm very hopeful.
Here's the other, I think, important number to look at was producer prices. We got that Thursday morning. And producer prices, of course, is what producers pay. And it sort of front runs what's happening with consumer prices, because obviously producers are paying more. At some point, maybe not immediately, they're going to pass it on to consumers. Producer prices have now fallen. Or I should say appreciation has now fallen to just 2.7%. It actually fell more than they were expecting. They thought it was going to fall to 3.2, so it fell to 2.7. And we're now down 9 percentage points from the peak that we saw last March. So we have seen producer prices basically collapse almost.
Yeah.
We're almost at the target rate. And that should be also kind of a hopeful sign that we're going to see also that top line number continue to fall.
Yep. So, I mean, we're going in the right direction, yet the Fed is probably going to raise rates one or two more times. Because the Fed always overdoes it. We just haven't seen them overdo it for a very long time. Like, when was the last time the Fed raised rates? Other than the tinkering, other than the tinkering with the rates between 2008 and 2000, well, just now. I mean, they've raised rates a couple times, they've lowered rates a couple times. But when was the last time they went on an extended rate hiking cycle? 2005?
I was thinking it was the 70s, 80s that we've seen this big of hikes in this kind of time period. I mean, we're due for a ninth, and I think I saw JP Morgan say that there might, because a lot of people are thinking this next one's going to be the last one. Right. But I think it was JP Morgan that came out and said that there could be that 10th. And so that's something that's up in the air. And so I think maybe, because what's interesting is, as we've watched bond markets kind of react to this news, we thought there'd be more of a positive move. I wonder if they're looking for a sign that this is going to be the last rate hike.
I'm a little surprised with the two consecutive, not weak, but weaker than we've been getting non-farm payroll reports, and the steady decline in CPI. Sorry, guys.
We're busy. This is good. This is good news.
Yeah, it's a client. Should have known better. The steady decline in the CPI, but we have seen the 10-year come off from a peak of 4.25, as I said earlier.
Yeah.
So, I mean, we're from 4.25 down to, I think we got down to almost 3.25. That's a significant move. So the fact that we're getting kind of a counter move today's report and yesterday's report, I would have expected interest rates to go down, and they've really kind of gone up just a hair. So I think now that's just noise. I think we can say that interest rates have come down significantly from the peak.
Oh, yeah. I mean, that's the data even highlights that. And that, of course, brings us to, after talking about inflation, the other big report that I think is really kind of frustrating, Jerome Powell and the Fed, has been the labor market. That, I mean, we've seen inflation cool, but the labor market has shown no signs of cooling off all of last year and the beginning of this year, except for this month. So we had some hopeful signs. Beginning of every month, we have Jobs Week, and we get a bunch of reports. We get initial jobless claims. We get JOLTS, which is job openings. We get the ADP, which is private payrolls. And then we get the non-farm payroll, which is the big report that everyone cares about. And this month was interesting because we started off, we got the JOLTS report, which usually comes out on Tuesday. Job openings fell under 10 million for the first time in 2 years. It was like 500,000 more or fewer job openings than they were even expecting. We had the ADP report disappoint, and we had initial jobless claims jump up because they made some changes to the model, and that played a role in it. And so everyone thought, finally, we're going to get a miss. We're going to get a non-farm miss. And we didn't. I mean, it wasn't exact. They were calling for 238, and we got 236. So it was pretty close to being right on the money. And it was sort of, you could almost feel kind of everyone just kind of deflating, like, we thought we were going to get that report that was really going to let the Fed go, okay, and kind of ease off of the accelerator. And we didn't get it. And I think it took a lot of people by surprise because all the labor reports were like, this month, it's finally happening. And then we didn't get it.
No, we didn't. We keep getting, the numbers continue to surprise me. I'm going to switch gears just a little bit here. The thing that surprises me, and I don't know what the fix is going to be, is that the spread between the 10-year Treasury yield, and interest rates, the 10-year Treasury is kind of a proxy for, it's kind of a guide for mortgage rates. They trade separately. Mortgage-backed securities trade separately from the 10-year. But if you're a fixed income investor, it's like, okay, I want to buy some treasuries. I want to buy some mortgage-backed securities. How much more risk am I taking by buying mortgage-backed securities? So they price them accordingly off the 10-year. The 10-year is the benchmark. And, throughout my career, which has been getting pretty long, 35, 38 years, the 10-year, the mortgage-backed security, the 30-year fixed rate on the street tended to be about 1.75% to 2% above the 10-year Treasury. And right now we're about 3%.
Yeah.
And that's not the Treasury's fault. That's not the Fed's. Well, I don't know if it's the Fed's fault. I don't know.
Everything's the Fed's fault.
People don't. The investors don't want the mortgage backs. Now, a lot of people do believe it's because the mortgage-backed securities right now are all going to refinance. Yeah. But that was never a problem in the past. Back in the 90s.
Yeah.
Rates went up a bunch. Mortgage-backed securities traded a pretty equidistant spread above the 10-year Treasury, and that's not the case right now. We could just have the 10-year Treasury stay the same, and we could have the spreads normalize, and we could see interest rates come down 1%.
Oh, wow.
Right.
Yeah, do you think it's just the changing of the markets and the way people are looking at mortgage-backed security? What do you think is causing that? Obviously people are concerned with the Fed balance sheet, I'm assuming, right? Where they own a bunch of mortgage-backs and
they're going to sell them or let them roll off. At least let them roll off.
Well, they're rolling off 100%, but I guess there's a fear out there that maybe they could sell them, and then what would that do, to the overall market? And so, you think that's impacting it, or?
I think that's a part of it, but I do think the biggest part of it is that people think that all the mortgages that we're doing now are going to prepay, so they're not worth a lot. But then, which is actually probably a good sign that a lot of people think that interest rates are going to go back down.
That's true.
Because if they were worth a lot more now, I don't know. That's just, but a lot of it does probably have to do with the Fed. And just the rolling off, you probably know the number better than me. How much is rolling off per month? By rolling off, what we mean is the Fed is not reinvesting the interest that they make off the mortgage-backed securities and the treasuries that they own. Where they used to reinvest it, they would use it to buy more treasuries and mortgage-backs. Now they're just letting those treasuries roll off.
Yeah, I think I should know because you look at the report, and every time they do their press release, they mention what they did with the Fed funds rate, and then they always mention what they're doing with regards to their balance sheet. And there's it's like a $10 billion difference. So I think it's like 30-20 or 20-10 or something along those lines as to what they're still purchasing. But they are still, it gets very complicated. Like I said, it's probably above my pay grade because it feels like they are rolling it off, but they are still buying some. They're just not buying, I guess, as much as rolling off. And so it kind of gets complicated because there's people today that still debate whether or not the Fed is reducing its balance sheet or not, because some people are like they are and others are arguing they're not. So
I think that with the bank, I think I heard a story that the very fact that they bailed out the credit lines that they gave to the banks around the bank failures was increasing their balance sheet. Okay. But it wasn't by buying treasuries, it was by buying the the assets that the banks owned.
Oh, okay.
And again, you're right. It's above my. I don't quite know what that means either. I do know that something is keeping the mortgage-backed security yields higher than they typically are. The spread between the 10-year and the mortgages is just wider than I've seen that I can recall.
Yeah, so. I think someone had mentioned there was a spread similarity between what was happening in the like around 2008. Not that, once again, this is not 2008, as everyone likes to say, but just with regards to sort of a contracting maybe economy. Or a time where, let's face it, in 2008, everyone knew a recession was coming. We didn't know it was going to be the Great Recession. And there's a debate right now. And the Fed even said so in their recent minutes that they are expecting a recession because of what's happened with banking. And so I think that the concerns about a recession are probably what's maybe also feeding into that spread kind of growing a little bit.
The very fact that they said that in their minutes yesterday and bonds didn't rally huge. I think we've had a pretty good rally, and we'll probably have more once the confirmation of that recession. Once we get, if we're going to get a recession and it actually starts showing up in the numbers, well, bonds will continue to rally. But going from 4.25 to 3.25, it's a big rally.
Yeah. I did want to talk a little bit about mortgage demand because as your phone's been blowing up, we are busy. We're busier, and we kind of known that. In the industry, it just feels like it here, especially at TowneBank, that things have been getting busier, and we finally got the actual evidence of that. There was a report from Black Knight that came out looking at March, and rate lock volume jumped 43% from the prior month, and it was a big jump. We're now at the highest level since August.
Wow.
So that makes sense, but it just showed that this kind of feeling that everyone in the industry's had that we are picking up from where we were in December and January, that it's real. The spring buying season is back. And, I've seen a lot of people say, you know what, for the first time in probably 3 years, we're back to seasonal sort of markets where everyone knows, springtime, this buying season picks up. You see kind of a drop off maybe in the wintertime. And for 3 years, we didn't have that because of the craziness of what was happening with COVID and everything else. We're now finally back to kind of a normalized seasonal market.
It is seasonal, although I would tell you, and we're almost all sick of hearing this, we'd be much busier if we had some inventory. We just don't have it, especially in Wilmington, because if you think about it, think of a clock face here in Wilmington. If you put the Bald Head Island, the very tip of the Cape Fear River, where the coast goes north to south and then it turns east to west. You basically, on a clock face here, only have from 12 o'clock over to 9 o'clock is land.
Yeah.
We have 3/4 of that clock face around us is water. So we have nowhere to go.
Yeah.
Can't build houses in the Atlantic Ocean.
Not yet. Dubai built a fake island. Maybe we should look into that.
We probably should. Maybe we should do that.
We can build up too. We can do that. There are zoning rules with regards to that. But also what was kind of cool, I thought about this report is that there's been a concern out there. A lot of people think that, volume has dropped off. So that means all these mortgage companies are going to stop lowering their standards and they're going to start going back to subprime and all of that. This report from Black Knight showed that purchases and cash outs actually saw their average credit score climb 1 point month over month. In fact, purchases are at 731. That was the average credit score in March. And then rate term refis were at 713 and cash outs were at 688. And so, year over year, they've seen maybe like a 10-point drop, but the fact that you're still looking at purchases being the average credit score, this is not subprime.
No, it's not subprime.
We're still seeing quality buyers.
Well, but not only that, you can see that Fannie Mae and Freddie Mac, at the very least, loans that we used to get an approval on when we run the loans for automated underwriting, where we would get an approved eligible, loans that you just knew you were going to get an approval. Now we're getting a refer, which means they're pushing some loans down toward FHA intentionally. So they've tweaked their system where the loan that we thought as a loan officer would go through conventionally is now there's definitely, if you have a higher credit score with just a little bit lower a higher debt to income ratio with a little bit lower credit score than in the past, you're not going to get approved. So that's another reason why people should come in a lot sooner, because loans that we used to say, sure, no problem, now it's not the case. Now we need to know if you're going to get pushed down to FHA. I had one the other day with a 46 back ratio and a 718 credit score that a year and a half ago would definitely have gone conventional. I could not get an approved eligible, and it had to go FHA.
And that all kind of points to the fact that this concern of, everyone always says that, right? Like I watch a lot of people on, YouTube and follow some other people on Twitter, and there's a lot of these sort of perma bears, I think they call them, these people who are always convinced, they watch The Big Short and they think they're Michael Burry, and they're like, I see the crash and no one else sees it. And they keep trying to find this data that'll prove that here's 2008 all over again. And it doesn't exist, because it's not. And inventory is a good reason why. But here's something that I think is almost just kind of funny under the circumstances. So we know that if you look at home prices month over month for the last 6 months, 7 months, I think, we've seen home prices fall month over month. We haven't seen it year over year yet. Case-Shiller, National Association of Realtors, no one has reported a year over year drop, which is the number that they actually use. But the loan amount in this Black Knight report, the average loan amount actually ticked up from February to March. But there was a report that came out, one from CoreLogic and another one was from Black Knight. And they both, for the first time in 7 months, saw a month-over-month increase in home prices, like a little bit, like just a little bit, like the falls that we've seen, like little drops month over month. This is the first time when it increased, and the reasoning was the inventory. Like the inventory is so bad, like it's so hard to find homes that it's now stopping this sort of decline that we've seen in home prices. And here is like a great example where we never really saw any real big drop in prices, not like San Francisco or Austin, Texas, or some other places where you've seen bigger drops in home prices. And now the spring home buying season's upon us. And it's like we can actually see home prices start ticking up again without any real big drop. I've
seen it personally. Clients of mine that have gone out to had made full price offers on houses, but they were that perfect price range.
Yeah.
$350 to $450, affordable for, your professional couple. And, I just had a client the other day call me, David, that house that we made an offer on a month ago, full price. When it finally closed, they saw that it closed for $40,000 over ask, and that was a $397,000 purchase. So the houses that have no issues in the right neighborhoods at the right price, people are lined up to buy it.
Yeah, and the thing is that what's happening, from my perspective, is you have people who are like, oh no, prices are going to fall, and so they've been kind of waiting. And they're like, hey, why aren't prices falling? And then, wait, all these people are starting to buy homes. And so it's almost creating like a little, like especially in areas like Wilmington, where you do have the demand and you don't have the inventory. It's almost like people are kind of waking up to like, oh, because there were people who were like, 2008 is going to happen again. Home prices are going to collapse and I'm going to get a deal. And they've been waiting and waiting and waiting. And now all of a sudden they're seeing homes go over ask. And they're like, wait, what?
And that's when rates are at 6 3/4. Yeah, wait till rates go to 5% and watch the crowd.
Yeah.
Yeah.
And so I think there's a realization that people are sort of coming to that there's no magic event that's going to bring you this deal. And that you got to realize if you can buy now, now's a good time to buy, and then if you want to refi later, you can refi, if you're happy with your payment, then you don't have to, if you want to buy, nothing's happening in the future that's going to make it more attractive to buy. And if you wait until rates fall, there's just going to be more competition and you might pay more for the house.
One of the basic tenets of economics is supply and demand. Yep. And so you can have a problem when you just have too much supply and demand is staying the same. Or vice versa. Mm-hmm. When you don't have enough supply and demand is going up. Right now, that's what you have. You have supply going down, or it's staying at very low levels, yeah, and demand increasing. You have it going the wrong way on both sides. So,
because demand fell. If you look at the data, we reached a 30-year low for mortgage demand. I think it was in January, and a lot of people said, here we go. Like we're going to see this big drop in prices. But inventory never increased. So sure, you saw demand drop, But when you have supply also at very low levels, they just sort of cancel each other out. So you see a little bit of dip in home prices, but nowhere near. I mean, if we would have had regular inventory levels and demand fall as much as it did, that would have had a bigger impact on prices. But inventory levels aren't there. And I don't think people realize that. Just go to Zillow. You can go to Realtor.com. All these websites that have these listings, and you'll be amazed not only at how few there are, but you're lucky if you get 1 or 2 listings a day.
I can tell you, when I moved to Wilmington in 2008, I literally moved here the month that Lehman Brothers collapsed, right? Okay, especially on Wrightsville Beach, every other house was for sale. There were for sale signs everywhere. It was like you drove into a neighborhood and it was like the first thing you saw was signs everywhere. Now you drive around, there's no for sale signs.
Yeah.
There's very few.
I actually saw a couple, and it surprised me because I haven't seen a for sale sign in a long time, because usually it's like the minute a house goes to market, it sells. And and if you it also does come down to pricing. I mean, we have seen a little bit of a dip, and that's why it's important to listen to your realtor, because they'll know what the price should be. Because some people go, well, no, Zillow says the price is this. That's what we should list it for. And then, people are saying, I'm not paying that much for that house.
Even at the higher end. I have a friend of mine that I used to work for, you've probably met, and he sold his house in Landfall, $2 million.
Oof.
He had 5 offers the day it went on the market. And I talked to him that day. I said, hey, I saw you put your house on the market. He said, yeah. And they were still waiting for another offer. People were saying, please don't decide. We're going to come in with an offer. $2 million. I wonder how much I have to talk to him about that, what he got over ask.
Yeah, no, that's...
I mean, usually the high end, if you're going to really have a severe problem, the high end gets decimated.
And you're seeing that.
Well,
not here. Not here. In San Francisco, they're getting hit the hardest. And like Los Angeles and places like where the housing markets are falling, the luxury markets the activity is falling off. But that's like $55 million
I know.
houses.
You're right. We don't have that. I mean, high end here is... on the beach is $5-7 million, and I know people that would buy houses right now at that price if they were available.
Yeah, I mean it's and that's also another reality with real estate, is that it is local, and so you'll hear horror stories out of San Francisco or Austin, Texas, or a lot of it's in the West. Seattle. A lot of the markets we're seeing some big corrections. And so people go, oh, here it is, it's happening. And then they look at the Wilmington market and they're like, whoa, what? That house is selling for more than it sold for last year? What? That's not supposed to be happening. And so once again, that's another reason why it's good to talk to people who follow this stuff like we do, and talk to someone who knows what's happening in the market so you can properly prepare yourself for what you're about to do, which for most people is the biggest purchase of their life. And so you want to talk to people who are like, this is what's happening in our market. It's not what's happening nationally, not what's happening anywhere else, but here's what's happening in Wilmington. So probably should end it there.
I want you to tell one story.
Yeah.
The story you told me earlier about the friend or someone that talked about it was proof that the Fed was, that the inflation was transitory.
Oh yeah. So I had tweeted about the PPI numbers, and it's this big loop. And so I tweeted about it, and I actually got a retweet from a well-known journalist. So all of a sudden, all these people, I think like 17,000 people saw this tweet. So I was getting all these responses, and one person said, "Oh, I guess inflation was transitory." And I was looking at it and going, yeah, after 9 Fed rate hikes. That didn't happen naturally.
In a year and a half. Yeah. What's transitory?
I mean, I guess everything is transitory on a long enough timeline.
If you're immortal.
Yeah. Well, isn't that the line from Fight Club where he says everyone's lifespan drops to 0 on a long enough timeline?
Exactly.
Inflation at some point will fall off. I mean, I guess unless we just keep printing money. But yeah, I mean, and it was so funny because not only has it been almost 2 years, but the Fed also rate hikes 9 times. So it's not exactly like that was an organic move with regards to the rates. I realized I forgot to do our NMLS number, so I want to stay compliant. So my number is 202-8201, and David's is 117378, and that will do it for the April edition of the Wilmington Mortgage News here at TowneBank Mortgage. And once again, if you have any questions, if you're looking to buy, it's so important to contact us here at TowneBank because, we'll let you know what you're getting, what you're going to be doing, what you're going to need, what's happening with the markets. And so, give us a call, email us, however you want to contact us, and we'll be glad to help you out. And David, as always,
till next time.
We're not going to wait 2 months.
Sorry about the phone.
Like I said, we're busy. It's a good thing. So we'll see you guys in May. That's the next one. All right, we'll see you in May.
Bye.
The views and opinions expressed in this program are those of David and Tyler and do not necessarily reflect the views or positions of TowneBank Mortgage.